Hi, I'm Jonathan Gurney, Portfolio Manager at Gurney Financial. The purpose of these videos is to educate and keep clients aware of what we are seeing on a daily basis. Our goal is to close the gap in communication between clients and the actual person managing their assets. We use fundamentals primarily and technicals as part of our analysis. We hope the charts and education help clients and viewers alike. A friendly reminder that this is not to be viewed as financial advice. As always, subscribe if you want to be notified as to when these videos come out. Appreciate the support along the way. So let's get into it. All right, here's the picture. Let's take a step back. These days, weeks, months are emotional. You regain some of your gains back, you go back even. I mean, that's really what's happening here. We keep testing key levels, and I've been saying for a while we might be range bound for a little bit. So let's take a look at the charts. Let's take a wider scope here. If you watch intraday here, these moves are insane. I mean, it was a 3% down day, and I mean, it was a 4% swing for some of my clients. That's just the reality. It doesn't mean we were down 4%. It was a 4%. We were up 1% at one point and went. I mean, if you're watching that on a day-to-day basis and not used to it, caution. If you can watch that and say, okay, these tweets are kind of funny, it's crazy how much this impacts things, that's fine, but just be cautious here. So again, fundamentals, technicals, interest rates, sentiment, those are the things we're always paying attention to. That's what we believe often drive the markets. Fundamentals are still okay. Technicals, we are in no man's land. It's a little bit iffy. We're holding key levels at this point. Monday will be interesting, and if I need to sell, I will. I don't think I will. But I will always keep an open mind and follow the market. So interest rates, it's a good environment for equities. So it's basically split in half, which is kind of what the market is in. A push and pull, tug of war here. Which direction are we going to go? It's hard in these environments for me to believe that we do go much lower. The backdrop remains so strong, but I still have an open mind. So keep that in mind. Earnings and interest rates, two of the main drivers, still okay. That's why we have not sold yet. That's basically what has kept us in. So hang in there. Pros and cons, we want to be real about both sides here. So let's take a look back and explain some of these pros and cons. Cons, inverted yield curve. That did happen intraday and aftermarket. We have still not actually closed with an inverted yield curve. I'll get to that at the end, showing you charts on that. It's kind of interesting. Still not a selling point, even if it does invert. So keep that in mind. Global slowdown. This is true. We are in a slowdown, but the Fed is helping significantly, and companies are still doing okay. So that could be a deadly combination if we get tariffs to improve. Tariff resolution right now does not appear promising. China's really not in a huge hurry to land a deal. Many administrations have tried in the past, have failed. I give credit to the administration to try to improve this. Do I like the way they're going about it? Definitely not. But there's a balance in everything. So it'll be interesting to see how this plays out. Technicals, again, are in no man's land. We've talked about that. Pros, global central banks are cutting rates. This is good. GDP is still okay. Unemployment and the consumer are still very strong. Hopefully we can get some tariff resolution, even if it means backing away from China and getting more benefit from other trade deals with other countries. That might be a benefit. But things with China, truthfully, just don't look very good right now. So let's go through this story. This morning, before the Fed spoke, China initiated initial tariff threats, basically in response to ours. You knew it was going to come. Of course, to do it right before our Fed meeting. Perfect. If I were to the other country, that's probably what I would do too. Fed speak at 10 a.m. They actually did. The meeting was actually pretty good. I would actually give it an A+. The Fed's doing what they can. Have they been perfect in the past? No. I mean, we were actually doing very well after that meeting, and then the tweets came. So for the second time in a row, dovish speak from the Fed, and the president responds saying that's not enough, that's not enough. Again, be a realist here. Any president wants low interest rates. Should he respond that way? No. I mean, he responded immediately with tariffs, tariffs, tariffs. The Fed, which one's fighting against the economy more, the Fed or basically the tariffs. But really, it's a combination of the two. They both made mistakes. Let's just be realistic about that. So it's just been nuts. Ignore it. But let's get to the charts. That's really what we want to spend time on. So we'll head there right now. So here is the week. We want to take a wider spectrum because if you look at the day-to-day, you're going to lose your mind. For most people, they just can't handle it. If you can, kudos to you. Here's the weekly perspective. It's really not that bad. What do we notice? Higher risk, higher beta went down more. That is normal. But the rut continues to be in a rut, which is the Russell 2000. We'll get into more charts. The day, I'll show it to you, but don't freak out. It was a 3% down day. So really what that means is we would have been positive about 1.5% had we just closed flat today. The tweets did have an impact, which is unfortunate. But what's really different than what we've seen in the past year? Nothing really. Just people need to learn that this is a normal part of this administration. Don't panic. Don't think it's the end of the world. Sure, we are watching key levels and we will react accordingly. But here's kind of, it's all perspective and time frame. Year to date, it's fantastic. As you see. The year, however, this is the real scope, and we want to be real about this. We've been in a 1.5 year consolidation moving sideways. We've been trying to make sure our clients understand that. There's a reason why you haven't seen much advancement in accounts over the last year. Now, again, we're not directly invested in these indexes. We pick individual stocks and bonds and so on. But this is the real perspective. It is going to happen. I do not want to be a seller until I see certain levels broken, and we are definitely not there yet. Now let's go to sector performance. I'm not going to spend a lot of time here, but oh, sorry, that's sector. Sorry about that. Those are some of the stocks I'm watching, by the way. So if you got a flash of that, doesn't mean I'm buying them. That's not a recommendation. It's stuff I'm watching. So there's a freebie for you. Doing this live, you got an advantage. All right. So here's the 1 year, the 1 day. You're going to see conservative areas did better today. Boom. Yep, right there. Conservative areas, utilities, real estate, consumer staples, and the ones that did worse. Energy continues to struggle, and I don't expect it to get much better. It's going to struggle in this area and environment. So keep that in mind. But really, right here, technology, communications, and consumer discretionary, we still want to be overweight in those primarily. We do have some in healthcare. We do have some in REITs, some utilities. So we're pretty well diversified, but we don't hold many stocks, usually 30 to 90. So we get a lot of volatility, but during these dips, these are usually opportunities to buy. So keep that in mind. So let's look at the charts, the things we've been paying attention to. Key levels, what we want to reiterate, 2950, say 2800. We've been talking about that for 4 weeks. Don't be surprised if we remain in this range. Something good that did occur is today we did test the 2844 level. I asked you the question, would you rather see the pain get out of the way in 1 day, or would you rather see it over time? I mean, that's basically what happened. We test the higher range, go down again. Test the higher range, go down again. We're at some key levels here. Could it be possible, and be open-minded to this, that we test the 200-day moving average of the 2800? Yes. I would be surprised if we don't. Here is why. After the market closed, we were seeing this. And I'm glad he was at least smart enough to do this after the market closed, because this would have been a sell-off. Basically retaliated, saying the remaining $300 billion in goods and products from China going to increase the tax from 10 to 15%. Cut out the drama, ignore the news. I want to see a sell-off as much as possible overnight. That's what you want to see. That might make you lose your mind, but that is what I want to see. I want to see that get the VIX high, get the put call ratio high, and buyers will probably come in sooner. So keep that in mind. If we go too much and close a couple days below this, I will sell. I don't expect to have to do that, but I will keep an open mind to it. Again, key levels that we've been watching, we've been saying here's kind of the range we've been in between. This is the QQQ, a Nasdaq follower. You're seeing we're still right in that range. So again, ugly day, but you got to see the real picture here. This is the range we've been trading in for 2 months. Don't freak out. Remain disciplined. And if I need to sell, I will. I've been saying, could we get another test? A retest, double tap, like I was saying last week? Possibly. And that could happen Monday. So keep an open mind to that. And if I need to sell, I will. Again, another kind of good thing right now, but something we got to pay attention to is key levels on the Russell 2000. The 145 level, look, tap up. Tap up, tap up. Hopefully we go higher. This is how brutal it has been in the Russell 2000. I mean, we are at the same levels as we were in June. I wish I would have gone a little further back to see how close we are to that in December. We're not close to that, but it would be interesting to compare. TRAN, which is the transportation average, something many analysts pay attention to, is to say, if we finally get some strength in the TRAN or transportation area, this will be a nice move for the rest of the indexes. And I do believe in that. It hasn't been a direct correlation recently. If you look at the correlation between the S&P 500 and TRAN recently, I mean, before this, we were finally breaking out, and look what happened. Boom, on the tweet. We went up, and down. So keep that in mind. I'm watching this, another key level right here, 2700 or the 9700 level on this. Something that I will continuously watch. And again, I'm not going to go into a real big debate on, did the yield curve actually invert? It did intraday and it did after hours, but here's the real story. It has not actually inverted on closes. It is not an immediate sell for me either way. It's something to be noteworthy and aware of. But again, the stats say you have basically a year and a half on average, and that's all we need. We're just going to leave it at that. I don't know if I need to go into that much further. I do believe this time could be very different with the Fed trying to get ahead of this. So keep that in mind. Gold, always on days like this, it's going to spike. So we're basically at that same top level. Probably get overbought on Monday. Same story. Could it go higher for a little bit longer? Yes, for somebody conservative, it might be an interesting buy. I don't know if I would do it yet, to be honest with you. It could be peaky. You might get a quick trade. Again, I view gold as a trade, not as an investment. Full disclosure there. I have no problem in saying that. I did say we were going to cover the TLT. Let's look at that. 20-year Treasury bond. Another nice day for that as well. Living proof that you can remain overbought. The 70 RSI for quite some time. Again, a little move down, the tweet up, boom. Again, I don't have a lot of interest here. It's in my mind overbought. Doesn't mean it can't stay there. But I'm more interested in either being in or out at this point. I'm not going to play around with some of these trades that are already a little bit overbought in my mind. So want to give you that real perspective. Let's conclude here. Make sure we're giving you a real perspective here. Give me a second. So odd stat of the day. This is the third time in the month we've dropped, and just this month, 2.5% in a single day. Kind of interesting on the S&P 500. It is the 496th time in history that has happened in the S&P 500. Doesn't make you feel better in the short term, but it is a reality. It's going to happen. In your mind, just listen to the trade range. The 2800, the 2950 level. I've been saying that for 4 weeks. That's all that is happening. It's unfortunate that the tweet occurred, but thank you again for listening to us. Please follow us on YouTube, subscribe if you like these videos. We're going to try to always give you a real perspective. Again, we are not always going to just be buy and hold people. We will sell if we are seeing true issues. Right now, it's about it's a tug of war right here between bulls versus bears, up versus down. So we're giving you a realistic perspective there. We did bounce up off key levels on Friday today. So thanks for your time. I hope you appreciate this. It's 7:53 my time in Ohio. It's a beautiful night. Don't let the chaos cause issues in your mind. I'm watching it like a hawk. And if I need to trade, I will. So thank you again for your time. Let us know if you have any questions. We are here for you. Thanks again, and subscribe. Thanks again.